Right now, as you hear this, the global silver market is shifting in a way we have not witnessed in modern history. Prices are accelerating faster than models predicted. Physical premiums are rising across multiple continents, and liquidity in key hubs is tightening by the hour. But the real story isn't the price. It's the trigger behind the move. According to trade desks in Singapore and Zurich, China has quietly activated a new round of export restrictions on refined silver, and the effect was immediate. The moment these restrictions appeared, wholesale buyers began scrambling to secure physical metal before the rules hardened. Some refiners paused international orders completely, while others shifted supply toward domestic industries without any public announcement. The critical detail is this: China doesn't need to control the world. Mining output to move global prices. They dominate the refining stage, the conversion of raw ore into high-purity industrial metal. When that flow tightens, every downstream industry feels it. Solar manufacturers, EV suppliers, chip producers, and even defense contractors are suddenly competing for the same shrinking pool of refined silver. And when competition rises faster than supply can adjust, the entire system reprices itself. That SY traders are now discussing a scenario that seemed extreme just months ago, the possibility of silver spiking toward $150 far sooner than expected. Not because of hype and not because of speculation, but because a key choke point in the global supply chain just constricted. And once physical scarcity becomes visible, markets don't rise slowly. They lurch, they melt upward, they reset. To understand how serious this moment is, you need to look at the physical flows. Over the past month, reports from Asian and Middle Eastern vaults show withdrawals, accelerating at a pace that caught even institutional traders off guard. Several large buyers quietly pulled tens of millions of ounces from regional warehouses, and the speed of these outflows suggests something deeper than routine inventory rotation. At the same time, European mints began limiting new orders, citing shortages of high-purity input material. Dealers in the United States started raising premiums even before spot prices moved, a sign that retail supply is tightening before mainstream coverage has even caught up. The clearest signal comes from the structure of the market itself. Spot silver is now battling futures prices for dominance, and in several trading sessions, spot has traded above future delivery. That condition is called backwardation, and it is one of the strongest warnings a commodity can flash. It means people no longer trust the promise of metal tomorrow. They want metal today. They will pay extra just to hold the real thing, and that shift is spreading. Industrial buyers, especially in solar manufacturing, semiconductor fabrication, and advanced electronics, are now placing larger and earlier orders to secure allocation before the situation worsens. When industries that normally buy months ahead begin buying quarters ahead, the entire supply chain compresses, lead times lengthen, premiums rise, and every squeeze in refinement capacity amplifies pressure on the physical market. What we're seeing isn't panic buying, it's protection. It's institutions acting before the public understands what triggered this phase. And that asks why the move toward $150 is no longer a fringe scenario. It's becoming the logical next step if physical demand continues to collide with shrinking refined supply. What makes China's move so disruptive is that it hits the single weakest point in the global silver chain. Most countries focus on mining output, but mining isn't the bottleneck. Refining is. Raw ore is useless to the industries that actually need silver. Phones, solar panels, satellites, high-frequency circuits, electric vehicles, and advanced defense systems all require extremely pure silver. And China is one of the few places with the industrial scale to refine that metal at the volume the world consumes. When that capacity becomes restricted, even slightly, the shock doesn't stay local. It travels through every supply line on the planet. The timing of this shift is what raises the stakes. We're entering a phase where demand is climbing faster than at any point in modern history. Solar manufacturers are consuming record quantities of silver. Electric vehicle producers are increasing their silver content per unit. AI data centers require powerful, silver-coated components to move energy and information at high speed. And military procurement, quietly but steadily, is rising across multiple nations. All of that demand grew under the assumption that refined silver would always be available. China understands this imbalance. They know the world built its energy transition, its semiconductor expansion, its electrification roadmaps, and even its defense readiness on the idea that silver would continue flowing at historical rates. So, when China tightens exports during a supply deficit that has already stretched across 4 consecutive years, it is not a small policy change. It is a strategic shift. It forces the rest of the world to compete for a shrinking pool of available metal, and competition on that scale never produces gentle outcomes. That's why the market is reacting the way it is. Prices aren't just rising because traders are excited. They're re-rising because the world's largest refining hub just signaled that the era of easy silver is over. And once that signal is understood, the path toward a much higher price becomes not speculation, but consequence. If China keeps these restrictions in place through the first quarter, the next phase of this crisis becomes almost unavoidable. The first effect will hit industrial users. Companies that rely on steady silver deliveries, solar manufacturers, EV producers, chip makers, and telecommunications suppliers will begin securing larger quantities than they immediately need. They won't do it to speculate. They all do it because they can risk being caught without material in the middle of production cycles. That kind of forward buying drains supply even faster and turns a tight market into a strained one. The second effect will show up in the global bidding structure. Nations that depend heavily on imports will begin competing directly with each other for refined metal. Mexico, Peru, and Australia can boost mining, but refining is still the bottleneck, and China controls a massive portion of that capacity. Even if raw ore is available, transforming it into the purity required for modern electronics takes time, infrastructure, and specialized equipment that can't be scaled quickly. The more the world pushes for alternative refiners, the more strain lands on facilities already running near full capacity. The third effect will hit the financial side of the silver market. If industrial buyers start requesting physical delivery on contracts normally settled in cash, the futures market will feel that pressure immediately. When too many players demand metal instead of money, exchanges face a choice: find the metal at any price or cash settle against the wishes of the buyer. Neither scenario ends with stable markets. Both lead to fast, violent repricing. And once confidence in paper claims begins to crack, investors rush toward physical holdings, accelerating the very squeeze they fear. These three forces, industrial hoarding, international bidding wars, and delivery pressure, have never aligned at this scale in the modern silver market. If they converge now, the move toward $150 won't require speculation. It will be the natural reaction of a system colliding with its own limits. What this all means for you is simple. We are no longer watching a market that moves on headlines or investor sentiment. We're watching a market that is being reshaped by physical scarcity. For years, the world relied on the idea that silver was abundant, that refining capacity would always keep up, and that supply chains would adapt before anything truly broke. But now the assumptions are failing. Physical silver is separating from paper silver. Premiums are rising ahead of the price. Inventories are thinning faster than analysts can update their models. And China's move has pushed the system past the point where normal corrections can restore balance. If export controls tighten again, if delivery requests increase, or if even one major industrial buyer announces procurement issues, the pressure will escalate instantly. Markets move slowly when they are comfortable. They move violently when comfort disappears. And the global silver market is entering a phase where confidence itself becomes a scarce resource. Once people realize the bottleneck isn't temporary, once they understand that refining cannot scale fast enough to meet the world's technological ambitions, the shift toward much higher prices becomes not a question of if, but when. The window to act is narrowing because the dynamics driving this crisis are structural. They are not easily reversed. Growing energy demand, rising military expenditure, expanding AI infrastructure, and a decade of underinvestment in mining and refining have created the conditions for a systemic break. China's restrictions didn't create the crisis, they exposed it. And now the rest of the world is reacting in real time, trying to secure a resource that is becoming more strategic with every passing year. In the next analysis, I'll break down which industries face disruption first, which nations are positioned to benefit, and why the decisions made over the next 90 days could shape the global silver market for the next decade. The melt-up isn't coming someday in the future. It's beginning right now.